Hello and welcome back everybody to another edition of the Forex Market Preview. Today we're going to talk about dollar pairs, and we're also going to take a look at that Aussie New Zealand trade that we looked at last week and find out if maybe today, maybe this week is the week to buy that thing on support. All that and more in today's edition of the Forex Market Preview. Okay, everybody, so last week we talked a lot. We talked about several different things. So I want to cover a couple of different things with you. I want to cover the things we covered last week, and then I also want to move into and discuss with you a little bit about a Japanese yen trade that I took in the middle of the week this last week and show you why stop placement is so important. So let's go ahead and just kick it in here on the euro dollar. I'm also recording this on a different software this time, so we're going to see if that improves the quality of the video at all, or allows me to do anything new with it. But if you remember last week, we talked about the bat pattern that was setting up on the euro dollar here, and that bat pattern, we actually ran up into that 886. And remember, on these bat patterns, what we're looking for is that 886 completion. We're looking for the market to reverse somewhere between the previous high and the 886. And as you can see, we ran right up into that 886. Market went just a hair higher than that and now has pulled back off of it. Now the question is, are we going to get down to our initial targets? Our initial targets here are going to come in at the 382 retracement. So if I bring my Fibonacci retracement tool in and I go swing low to swing high, boom, you're going to see, look at that 382 retracement there, but look at where it comes in on structure. Look at that little lip of structure comes in right at that 382 retracement. That's going to be a very good place to look for our initial targets to come off at. However, we don't know whether or not the market will get all the way down here. Stops need to stay above X, and we need to see that market press all the way down into the 382. Now, given the average true range of this market, I don't know that we will necessarily get there next week. If we see a significant push lower, dollar strength into next week, or into this week, we may end up hitting that 382. If not, we may have to wait another week. The opposite could happen. I guess we could go north as well and end up getting stopped out. So we'll just have to wait and see what ends up happening with this. Let's take a look at New Zealand. New Zealand, we actually have a cipher pattern setting up here. I'm going to go ahead and draw that in for you just by grabbing a couple of Fibonacci tools. And again, guys, if you don't understand the patterns, if patterns aren't something that you're real familiar with, or if you haven't ever invested the time to actually learn them, they're extremely powerful. And I have a advanced pattern trading course that's very cheap. I'll put a link underneath this video that you guys can go and check that out. But as you can see, guys, the cipher pattern setting up here, looking to sell the 786 at around 84.44s, stops again above the highs. Now, one of the things that we look at here on the Forex Market Preview is typically higher time frame stuff, that daily chart, the 4-hour chart, so that you guys get an idea of what's going to be happening, where the key turning points may exist into the following or into this week. And I give you some trading ideas, and I tell you a little bit about what I'm looking at. One of the things that you can do is you can always drop down in time frame on anything that we cover here, any of the patterns that I show you, any of the structure levels that I show you. If you cannot trade higher time frames for whatever reason, either your account doesn't allow, you don't have enough money to trade higher time frames to account for the stops, or you cannot reduce your position sizing enough to trade those types of setups, you can take all of this information and just drop it down on time frames. So if you know that we're coming into a significant resistance or support level, and that's a level that you may want to trade around, you can always drop down that time frame and look for a setup on a smaller time frame. Maybe you look for that double bottom on the 60-minute chart, or maybe you look for some consolidation on a 15-minute chart, giving you an indication of where that market may end up rallying, and then you can take some positions in the direction of the underlying trend or in the direction of the potential reversal, while at the same time not taking on as much risk as you would be if you were using it on a daily chart. And again, in my courses and things like that, I cover this in much more detail, but for our purposes here, just understand that everything that we're doing here can be done on a smaller time frame. So New Zealand has that cipher pattern setting up, and if I come down to the pound, here is, again, this the New Zealand trade is really if I go back to the New Zealand trade, this is, the market has been rallying here. We've come back. Now the market has hit a point of exhaustion, so we've had a rollover. Now the market is going to rally back up, and when we do, we will most likely break these structure levels. When we break those structure levels, that would technically make us bullish. So we're going to be selling in a bullish market. So that would make this a relatively, this is a counter trend trade. Now, if we go over to the pound, this is a trend continuation trade. If you guys will remember, for the past couple of weeks, we've been talking about this, the ABCD move, the consolidation, and I said, hey, watch for the breakout, either up or down. That's going to signal where the market intends to go next. And as we can see here, the market clearly broke out to the upside. And now we have to look for where are we going to get involved in that trade. And here, one of the main trend continuation trades that I teach is wait for the retracement. So the market has broken out. We're now going to wait for the retracement back down into previous structure resistance. Look left, structure leaves clues. Look for that resistance level. As the market pulls back down into that resistance level around 162.45s, you're going to look for you're going to look for an entry, a long opportunity. Now you can do that by simply buying as the market hits 162.50s. You can wait, you can drop down a time frame to maybe a 4-hour or a 60-minute and wait for a double top or a double bottom. There are a multitude of ways you can wait for the market to turn up and print a higher high, higher close. You know, there are several different ways that you can enter this market. But what we want to try and do is give ourselves the least amount of risk with the most amount of reward. And the least amount of risk with the greatest potential for reward will exist somewhere between 162.40 and here around 159.15. So this is actually the area that the market can move in, and I'm not going to go into too much more detail about how we can enter this, or what happens if you can't absorb the risk from here to here. How can you potentially still take advantage of the trades? All of that gets covered in more detail in other training lessons or in other courses that we have. But as the market pulls back down into here, 62.45, 62.50s is going to present a buying opportunity for those of you who are trend continuation traders. Now, let's jump over to the Aussie. Aussie dollar. Look left, structure leaves clues. We ran into support. The market double bottoms against that support level and then rallied off of that. We have now come back down into that level. We haven't quite hit it yet. So one of the major things that traders will do wrong is they will try and buy this up too early. They will see this market start to rally. They'll get really nervous about missing the move, and then they'll end up entering here, and then the market will go ahead and roll over down into the potential reversal zone. You want to wait for this market to press down, or my personal preference is to wait for the market to press down into this zone. It's a narrow zone here on the daily chart between 8,900 and 8,850. So there's only about 50 pips in here of potential reversal zone. If the market is going to reverse, highly likely that it's going to do so in somewhere in here. And the market hasn't come down in there yet, and we're not oversold. So if we're not oversold, we haven't entered the potential reversal zone, this is not the time to be buying up this potential trade, regardless of what it does. It could, skyrocket after today. We don't want to be involved in that trade because it doesn't present us the best possible risk to reward opportunity. So, moving right along. Let's take a look at, before I get into my last thing that I want to talk about, which is the Japanese yen trade, let me scoot over and look at the Aussie New Zealand trade. Now, guys, this is one we have been looking at. This is the one I said may be the buying opportunity of 2014. We're there. We're sitting on it. Okay? If I scroll left, if I consolidate my chart up, and I'm just going to pull over here so you guys can see it a little bit better. It'll take me a minute because it's a long way away. Okay? The support level. Here is the previous support level. That's the lowest close. Now again, if I consolidate this chart way up and I kind of scrunch it over here, you're going to see what I mean by that. So you see how that's where the market closed, and we are sitting now right on that close. If I zoom in here, you guys are going to see how we're sitting right on that level. And the question is, will the market rally out of here, or will we continue lower? But we are at a major structure support level. The market is oversold. And we held for 1-2 days at that level. So there is a potential buying opportunity here. Now, I already told you what my play was on this. I already told you how I was going to handle this. I was going to be looking down here on these lower time frame charts. There is the double bottom. So there is an opportunity here at the open. Stops have to go below the double bottom low to see if the market will actually rally off of 108.36s. If it doesn't and we continue lower, then you're going to take a small loss on the trade. But you have the double bottom, you have the bullish divergence coming in on the RSI on that 4-hour chart. And actually, we haven't quite, have we hit the double bottom? Let me double check this. Because we have very specific rules. One of the things you'll notice about the way we do business here is we have very specific rules about what constitutes a double bottom. And in this case, we have not met that standard yet because the lowest low of the second retest must at least touch the lowest close. So we have to get this market to come down and at least touch 108.24s for us to have a double bottom. So we don't have that double bottom yet. So what we're going to do is we're going to watch for that, and if the market comes down into there, there's your double bottom bullish divergence looking for a rally. It's going to give you a very, very nice risk to reward ratio. Because even if you're basing where you're going to take your profits off on this 4-hour chart, you're looking all the way back up here around 110.35. So you're looking for stops will go somewhere below the swing low here. Let's just say 70, 101, 107.70s. And your targets will go here. So you're looking at, to target one, an extremely nice risk to reward ratio. So we'll see. We'll see what happens with it. I have no idea what's going to happen. I'm going to have to wait till the market moves after we open up here in a few hours to make my decision about what I'm going to do and how I'm going to trade it. But I already have my plan in place. If I can get that double bottom with the bullish divergence on my trading time frame, that's something that I want to be involved with. So now I want to move over to the last thing that we're going to talk about, which is the Japanese yen. And I want to discuss with you guys a little bit about stop placement. This is one, I'm getting ready to do the live show next year. Those of you who have not been following me, who are not part of the syndicate, number one, if you're not part of the syndicate, you should be. But if you're not part of the syndicate, you may not have gotten, you didn't get the invite that I had the other day where I brought some people in, about 30 or 40 traders, to watch a rehearsal of a live show that we're going to be doing next year. And we were testing out a bunch of different things with it, the video and audio, and making sure everybody could see everything and that we didn't have any lags in audio and all those types of things. And while we were doing that, I was doing some live analysis for the traders who were there, and I identified this particular trade, and I said, hey, I have to trade this. And I said, give me a minute. I went into my trading platform, I placed the trade, and then I came back. And I want to share with you guys a little bit about that trading opportunity, where I put my stops, and why I think it's so critical that you use proper stop placement when you're making your trading decisions. So I was looking at, the market was trading here. Let me just turn on bar tick replay mode. Okay. So we were trading basically right here. This is where we were at. Market had rallied up into that resistance level. We had pulled back, and now we had rallied up, and we were retesting those previous highs. I was looking down at the bottom of my screen. I identified the bearish divergence that had existed there, and then I said, what? What's the next thing that we need to look for whenever we find this type of opportunity? Where's structure? The first question that you should ask yourself during any potential area of consolidation or expansion, any double top, any potential counter trade opportunity, any trend trading opportunity that you might find, the one question that you always have to be asking yourself is, where is the market relative to structure? Look left, structure leaves clues. So I'm going to collapse my chart up here, and lo and behold, look at what I find. The previous high coming in there at structure resistance. Now I can go and collapse this chart way up, and you can see that there is really no structure again until we get all the way up to about 110s. Okay, no significant structure levels up to 110. So the market is either going to hold here at 103, or highly likely we're going to 110. It's the same situation that we discussed in the pound, where we were waiting in that consolidative channel and saying, hey, if it breaks up, then we want to be bullish, and if it breaks down, then we want to be bearish. In this particular case, we're simply doing the same thing. We're watching the resistance level, and we're saying previous structure resistance, again, becomes resistance. The market pulls back. We rally back up in to that resistance level, and the market puts in some bearish divergence. This is my lowest risk point of entry from a risk-reward ratio. So I ended up shorting the markets right here around 103.27. It was almost right on that level. I'd have to look at my platform to see exactly what number I got, but it was right around that level. Now, my next question is, where do my stops need to go? Now, this is what's critically important, is that most people will put their stops right above, 10 pips above the high. They say, if we break above that high, then I don't want to be involved in the trade. I want to be out of the position because at that point, I'm probably wrong. At that point, the market's probably going to run on me. Well, the problem is that that's what most inexperienced, most novice traders, and some experienced traders do. That's where they put their stops. Now, if most of them put their stops there, what do we think is sitting right above these highs? There's probably, a ton of stops that are right above this level. Okay? Now, not only do we know that, or can we assume that, but also professional traders and large groups of traders know that as well. And you get a lot of institutional traders and a lot of groups of traders who have the ability to move the market temporarily. They can move the market up into those levels and attempt to trigger those stops. It's called stop hunting. There's nothing illegal about it. There's nothing underhanded about it. It's part of the game. Now, if we know that those stops are up there, we have an idea that those stops are up there, we are at serious risk if we put our stops alongside those of stop hunters coming and grabbing our stops. And so the rule that I use for this is you want the stops to be far enough away that they're not easily triggered by institutions or groups of traders who are stop hunting, yet not so far away that you're going to take an abject amount of risk. Another thing that I pay very close attention to is where are my round numbers. So on this particular chart, see we're sitting at 103.27, but right up here we got 104, the even-handled 104. Okay, this is a very important level because markets tend to be both attracted and repelled from those levels. And I just skipped ahead, so my Bartik replay for some reason just went off. But let me go back. Okay, so we're sitting here at the resistance level. So I chose my stops. I said I'm going to put my stops at 104.08. Just above the 104 even handle. So, if the market runs up into 104s, I'm going to give it a little bit of room. But once we get above that, so I'm giving myself some leeway there in the event that we run up into 104s so I don't be taken out on my protective stops. So here's what happens. Back to the Bartik replay. We move forward. Market pulls back right off that level. I feel like a hero. We get another down day. I'm feeling even better. I'm up 100 pips or so. I'm feeling pretty good. But remember, I'm looking for a significant reversal here. I want this market to come all the way back down at least to the previous structure level at 101.76 and potentially all the way back down into here at 100. So I'm looking for a significant move here, and then the next day comes. Boom, and we're back up into the resistance level. All of my profits are gone. Emotionally, what am I doing? Well, I'm okay because I understand what's going on. I've accepted the risk at the beginning. But what are most traders doing? Most traders are extremely upset. They just watched all their profits go on, saying, why did I do that? I should have taken my profits off early. Why was I so greedy? Why did I go after so much more profit? Yada, 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 yada. Another thing that they tend to do is say to themselves, well, you know what? I was up money. Now that money's gone. I'm not going to lose any more money. Right? So stops moved. So stops moved from 104.08 down here to just above the previous highs to protect us because we don't want to take that much loss. Then we get the next candle. Boom. Market runs all the way up. We actually tap 103.92s, I think was the high for this. And then the market pulls all the way back off of that. Guy who leaves his stop in place is protected. Guy who moves his stops, guy who gets fidgety, guy who lets emotion of being inside the trade dictate his trading decisions ends up losing big. Now, guys, here's what I want to tell you. I have no idea what's going to happen with this position. It may rally up, and I may end up getting stopped out at 104.08 and taking a bigger loss than the guy who moved his stops. What I'm telling you is, over time, when you allow emotion to dictate where your stops are going to go, and you allow those types of decisions to be made while your money's at risk, you are playing with a losing hand all the way around, because you're going to continue to make emotional decisions in your trading. There are 3 things that you must know before any trade gets placed. And that is, where am I getting into the trade? Where am I getting out if I'm wrong? And where am I taking my profits if I end up being right? Those 3 questions get answered before we put any money at risk. And once that money is at risk, we step back. And we say, you know what? I made those decisions when I had a clear head. Now that the trade is on, I don't have a clear head anymore. Now I'm making emotional decisions. And in this particular case, as of right now, I'm feeling very, very good about the fact that I left my stops alone, that I allowed the trade to play out, and that we are still sitting well within, if I bracket out my potential reversal area, well within the potential reversal area here. So this is all still looking very, very good, and I'm going into next month, or going into next week, feeling pretty good about the position, and we'll have to see what ends up happening over the course of the next week. So, and today, we took a look at New Zealand and the cipher pattern, the great pound dollar and the trend continuation trade. We took a look at the euro bat trade from last week and looked at we're up money on that. We looked at the Japanese yen and discussed a little bit about stop placement there that we just discussed. And then we have the Aussie New Zealand trade, which is sitting at that support level. So all those things covered this week. So I'm very, very excited. Keep an eye out for next week. I've got to check the schedule. We're going to be having a holiday, and I didn't bother to check before I started this video, so may or may not have the Forex market preview next week due to that. However, I am going to be in the live room next week for 2 or 3 days. So those of you who are live room members or 12-week transformation folks, I'll see you guys next week for some live trading in the live trading room. Until then, good luck and good trading. I'll talk to you soon.